Thank you, Mr. Rara, for that very thought-provoking presentation. Also, before we start the panel discussion, I just wanted to thank you, Mr. Prasad, for focusing two panels on such an important topic. Infrastructure is backbone of any economy, and as we heard the Honorable Minister, I think there's a significant need for Indian development, given the various sectors, each sector requiring infrastructure being built. And I think the government has been focused. We've been having several discussions over the last couple of years on how to develop the sector, and infrastructure financing plays a dominant role in that. As Indian diaspora, I was part of that diaspora. When I was moving back to India, it seemed like a hardship posting. And the main concern was infrastructure, just the ease of living in India, whether we are going to be able to adapt. And it was supposed to be an experiment to see if, we can contribute and adapt to what in our minds was a difficult place to live. But I was very pleasantly surprised when I moved back, especially to Delhi, just seeing the development and infrastructure that has happened. But then when you travel the rest of the country, you realize how much more is needed. And specifically when you compare it, when you travel to other places, I just came back from Thailand and I was blown away by how much they've developed their infrastructure compared to ours, or Burma. They have 16-lane highways in their capital. But I think we all recognize as Indians and Indian diaspora the specific issues that India faces compared to some of the other developing countries. Leave aside the developed countries, we are the world's largest democracy. If anybody had any question on the vibrancy of the democracy, I think that's been settled by what we've seen in the recent days. A new party coming and actually winning elections. I don't think that's happened anywhere else in the world. But that brings with its the challenges of disruption. If you're planning as a government certain things and there's disruption due to elections, then long-term infrastructure projects suffer. We also have a not as well-defined federal structure maybe as the U.S., but it's definitely there, and it significantly affects any reforms in infrastructure sector, because there has to be a buy-in both from the state and the center and great amount of coordination. And again, our economy, for the size of the economy, it liberalized only couple of decades ago. It's very fledgling. The financial sector is still growing. And we are learning, and we have to do it in the context of the number of people we have to elevate out of the poverty line in India. So it has to be an inclusive growth. So significant challenges, and you put that in the context of infrastructure financing. And I was reading a paper by Mr. H.R. Khan, who was the Deputy Governor of RBI. And he very succinctly laid out what the key issues on infrastructure financing are. And I'll just put that out as the base for discussion as to the issues that we need to get addressed. I think if you go back to the 12th financial year planning, it looked at a estimated trillion million dollars of financial needs in the infrastructure sector, and there being a gap of about 67 lakh crores that needs to be funded. And the global slowdown has, of course, created further concerns around that gap. Probably has widened since then. There's the fiscal burden on the government. There are competing demands in terms of education, healthcare, other sectors. The Indian banking sector needs reforms, has significant NPAs. There's an asset liability mismatch, and the economy has relied too much. I think that's we're going to be discussing quite in detail on the commercial banks in India for financing rather than other asset classes. We've tried to develop takeout financing, which has its own issues. specifically commercial banks giving out up their operating assets after having taken the teething pains. Um, Investment obligations of insurance sector, pension funds, provident funds, they haven't been as active a class of investment as some of the other developed jurisdictions. Big issue has been lack of vibrant corporate bond market in India, which is a huge focus area for the government. We don't have a municipal bond market for financial urban infrastructure development. I think that's the next panel. And the user charges in India for infrastructure have traditionally been low. So in the background of all of that, um, if I just start with Mr. Rao, with you on IIFCL, we know has been at the forefront of providing infrastructure financing, creating innovative ideas. If you can just walk us through, what is the thinking at IIFCL in terms of bridging, firstly, the gap that we just talked about that needs to be addressed.
Okay, thank you, Pratibha. Good morning to all of you. I'm coming from IFCL, the Apex Institution of the Infrastructure for the country. It's specially launched in 2006 and it's exclusively for the development of the infrastructure. 100% owned by the Government of India. Now, in the last 6 years, whatever the best can be done within the policies, we have already having around $6 billion of balance sheet, and it's growing at 20% every year. Now, coming to the infrastructure point of view, what already the Honorable Minister has mentioned and what Pratibha has already mentioned, IFCL is a part and integral in the policy making and coming out with various financial instruments for catalyzing the investments into the infrastructure in the country. Having said that, I want to make it very clear and for the 11th five-year plan which we had done, it's around $500 billion successfully done, and we expected private investment to come only 25%. We got 37% investment from the private sector, and a lot of contribution has come from the overseas also in the form of FDI and other FII. Now, seeing that, again, the Planning Commission, the Government of India, has worked out and it had come out $1 trillion, which is equal to 65 lakh crores as we talk today for the 2012 to 2017. Now, in that, this money will be going into 29 subsectors of this country, which is defined as infrastructure, which includes in every sector like energy, into the transportation, telecommunication, urban and social infrastructure, which constitutes as 5 major, but 29 are the subsectors if you break it. Now these sectors are all moving around, but not at the same pace. One of the successful story in the world in India is the telecom sector. Today it is at the ARPU of less than 4%. Still EBITDA margins are at around 35 to 40%. All are making profits. That's one of the thing, and this is the lowest in the world. Similar things are happening in the airlines as we move forward, and similar things are going to happen in other sectors as we move, and the policies are corrected time to time. Now that's from the policy point of view. Now, when we had done the analysis of the 65 lakh crores which is required for the next 5 years, there is a gap of around 18 lakh crores which is coming out. Now, this 18 lakhs has to be bridged in the next 5 years. For that, various options have been worked out. One is the credit enhancement, takeout finance, infrastructure debt finance, debt fund, and attraction of the FDIs and the ECBs. So now these things are all being put placed by various regulators and the policy agents, policy entities. So ECBs have been corrected by the Reserve Bank of India. A lot of ECBs are coming into the country because of the relaxations. Then similarly, a lot of FIIs are coming into this one to put into the corporate and infrastructure bonds. And similarly, the IDMs which have been launched last year are going to take place from this year itself, which right now I'm heading one of the IFCL infrastructure fund, which is going to be launched shortly. The operation is very shortly in this month or next month. So having said that, IFCL is in the forefront to create new models, financial models. One of them is the credit enhancement, which we are trying. So the bond market develops in the coming years, and for which already 5 pilot runs have been done for various sectors, one in the power sector, another in the road sector, and another in the wind sector. So this will actually catalyze the investments into this infrastructure project, and the cost will be brought down, and the credit enhancements are done, so that the projects are becoming more and more sustainable in the long run. That's one. And similarly, like IFCL, IDFC is also there, which they can also do because it's a special institution for infrastructure. The other one which we are doing is takeout finance. This is another instrument which is there, so that the projects which are already operational and asset liability mismatch can be minimized, so that right now banks are funding around 45% of the infrastructure. So that has to be minimized. So IFCL and other institutions which are like IDFC, they do the takeout finance, so that they take away the assets after the operations are over and take it onto their book and give it at a lower interest rate. So the project sustainability will be there. This is another instrument which is there. Then IDFs which are going to invest, they are also going to give structured products either through mutual fund route or through the NBFC route, so that a cheap money and long tenors can be given for the operational project, so the project sustainability will be there. So these instruments IFCL is pushing into the market as a cattle agent and as a lead institution for the infrastructure development, so that the growth in the infrastructure in the next 5 years picks up. It's complementing whatever the plans are there in the government and other agencies, so that the investments comes into the country and then more and more infrastructure projects takes place. Having said that, I would like to mention different sectors which are coming. Actually, a lot of investments can come as PCPR region, which is coming up in 3-4 regions. One of the region is in Andhra Pradesh. It is 600 square kilometers, where almost 5 to 6 special economic zones will come up for petrochemical industries, and a lot of investments are going to come, which is operational. Similarly, ITIR, infrastructure, information technology investment regions. This is coming, the first one is going to come in Andhra Pradesh again, in Hyderabad area, where around 40,000 acres have been allocated, so that lot of investments can come into the IT. So present exports, which we have around $70 billion, are likely to go up higher and higher in the coming next 5 years. Similarly, we have SEZs, then in the airports, then we are having power is going on increasing, and value-added service in the telecom sector is also going to happen. So $1 trillion, what we are estimating, of course, this is based on certain assumptions of GDP. Forget about whether it is 8% or 9%, but even with 5 to 9%, maybe in the 5 years or in the next 6 to 7 years, this investment has to happen, because that much of demand is there and cheap valuations are there. So definitely there is a good valuation which can be given from these assets to the foreign investors. That's in nutshell which I can say what IFCL is trying to do as a cattle agent in the development of the infrastructure.
Thank you. Before we drill down into the various alternative instruments that you mentioned, Mr. Agarwal, if you can just talk about the need itself of these specialized institutions for infrastructure development and financing.
Sure, thanks, Pratibha. Before I get into that, I'd like to just draw the attention of everybody into 2 or 3 seemingly unrelated developments over the last couple of decades, and then try to see as to what we have missed out and what could be the need. One, traditionally, project finance in India was funded by 2 or 3 major so-called development financial institutions, namely IDBI, IFCI, ICICI, etc. Now, those DFIs have, over a period of time, withered away and given way to universal banks. So project financing, which was the forte of a few institutions, became a vacuum over the years, and willy-nilly it was taken up by commercial banks. There was no other way. Somebody had to fund that, and commercial banks came up and funded various projects for long-term with long gestation periods. So that is one development over the last decade and a half, I would say. Second is there has been a realization in government and policy circles that infrastructure is the country is enormously in deficit on infrastructure, and therefore infrastructure needs to be developed. And government is having its constraints on financing, and therefore PPP model was evolved about a decade and a half ago, and a lot of projects were started getting awarded through public-private partnerships to private sector players, and infrastructure was sought to be developed on a pure project recourse basis by private developers, and therefore the need for project financing by institutions went up exponentially. And this happened in the backdrop, as I said earlier, that the DFIs had withered away and given way to universal banks. So the pressure on the commercial banks grew even more to finance these long-term project costs. The third development has been that India has always had a very thriving construction market, and since this PPP model was coming up, many of these EPC developers thought that EPC providers thought, or the construction majors thought, that it is good. In order to secure contracts for their construction, they thought that it would be a good idea to start bidding for some of these projects, whether they are road, power, or airports, ports, whatever. And as a matter of forward integration, and they started developing these projects. And not only that, the regulatory regime got developed in such a way that in many cases these developers were required to hold significant stakes in these projects for a long time to come. Now, this has led to a number of such situations which we are all aware of, that there is an asset liability mismatch that we are facing at the banks. There is a financing issue for long gestation infrastructure projects. Corporate bond is not very well developed. I'm not getting into the issues, but a couple of thoughts that I would like to lay here with the audience is that, one, I think there is a time has come when we need to think about the need for specialized institutions for infrastructure development. And I think we will all have to think together whether the EPC provider also has to be a project developer, and he also has to necessarily own the project for 15, 20, 30 years. Can they be three different entities? Can the project pass on? Can the EPC provider just provide the construction inputs which he's best at? Can there be an entity or a set of entities which know how to build a project? They have their own skill sets. They should be allowed to build the project and then pass it on to somebody who can hold it for a long period to come. And this third entity would be having a much lower return expectations, but would also have much lower skill sets in developing the project. He need not really have the skill sets in developing the project, but he can own the project once it is ready, and then continue to earn moderate but stable returns, extremely stable returns for a long time to come. So that is on the developer side. Similarly, on the financing side, there have been some developments in the recent past, and my colleague Dr. Shankar Rao just mentioned about the infrastructure development funds. So, and the lead that IFCL is taking in takeout financing and so on. So there is a need for specialized institutions which could take over the financing from banks once a project has reached commercial operation and it has reached stability. Banks are best suited to finance a project when it is being constructed. They know the developer very well, they know the local conditions very well, and they should be allowed to, they should be ideally be placed to finance these projects when it is being developed, and till the time it attains a certain level of maturity, a certain level of stability. But once it achieves that, it is best that this financing also passes on into the hands of certain other institutions, takeout financing institutions, infrastructure debt funds, and maybe a whole lot of other ideas that we can deliberate. Mr. Ratha talked about a few ideas. Then these kind of institutions can hold this debt for a long period of time. This will be moderate but extremely stable returns, which both Indian and global investors would probably be comfortable with. Thanks.
Thank you. I guess both IIFCL and L&T are looking at launching their IDFs, but it's been around for 2 years, or at least when the government allowed it. The markets have probably not been it's not been probably the right time to raise funding, but there's always a question, especially for this audience, of raising finances overseas. And Mr. Pathak, if I could just come to you on that, what is the kind of financial investors that we should be looking to attract to the Indian market, and what have been the concerns around that? Specifically, globally, we've seen, for example, the pension funds, they contribute to about 40% of the infrastructure financing market. However, we haven't seen those numbers in India. I think it could be as low as probably 6%. So what do you see as the constraints, and what do you hope as the kind of asset class that you can attract these investors to?
Thank you, Pratibha. A little bit about SREI. We have about $7 billion under management. We've been around for 24 years, and we have made a lot of money for our stakeholders. Hopefully, you'll be a stakeholder going forward. I actually didn't know the audience, so if I can hazard a guess, some of you are providers of money. Some of you are selling products that will be used in Indian infrastructure, services that will be used in Indian infrastructure. Some of you would be consultants. My favorite set of people who confuse plus insult is equal to consult. Some of you would be investors into India, and some of you, and almost everybody, would be users of infrastructure. So all of us, I'm happy to engage offline after this session on specific business opportunities. But I'd just like to say that all of us are future pensioners, right? All of us look forward to the day that when we hang up our boots and start earning a well-deserved pension. And none of us want to see that pension blow up in our face. And therefore, I'm saying that since Pratibha asked, what are the kind of things that international pension funds ought to invest in? Please do not invest in Indian infrastructure projects. I am completely serious. Please invest in Indian infrastructure assets. Projects are under construction. Assets are completed, which are throwing up cash. There's a big difference. The problem with, the wise men and women in India is that we have been trying to get dollars for projects, not assets. And one of my favorite themes is connecting deals and dollars. The kind of deals we are offering to the dollar is the kind that the dollar should never look at. So almost all of you would have landed at Delhi airport. It's an asset. It's not a project. 5 years ago, it was a project, and I would hate to get a single dollar into that project, right? So let me just describe this as caterpillars turning into butterflies. So India has so many caterpillars, which are infrastructure projects under construction, which are going to turn into butterflies in the next 3 years. And we financial engineers will put together structures where the dollars can invest in the butterflies, not the caterpillars. More of that later.
But Mr. Pathak, then projects need financing before they can become the butterflies.
So if you permit me, I think it's very silly to expect a low-risk pension fund to invest in a high-risk infrastructure project. There are, providers of finance who love risk. There are providers of finance who may not love risk. I think it's downright myopic to expect a low-risk provider of finance to get into a high-risk project. So let me again come back to my caterpillar and butterfly example. We can redefine it as primary financing of infrastructure and secondary financing of infrastructure. Primary financing is when Delhi airport was under construction. Secondary finance is when it's up and running, and you know that not much can go wrong except the sky falling on our heads. So the providers of primary finance, according to me, would probably be Indian providers of finance. The providers of secondary finance could well be international providers. So for instance, you mentioned OECD infrastructure. You see, Pratibha, OECD, the infrastructure is built. It's already there. India is creating the infrastructure. So when a Canadian pension fund buys a stake in a Latin American airport, that airport is ready, up and running. It's not under construction. So if I have to, offer a product to global pension funds, let's say the Canadians, the Americans, the Australians, the Norwegians, the Northern Europeans, I will put together a pool of, let's say, 20 cash flow yielding assets, butterflies, which will have a guaranteed cash flow every year. So 3 power plants, a couple of ports, 10 highway projects, which are generating cash. And that is when I will give you 8% dollar return over the next 20 years, because the one thing I'm sure of about India is that our population will not stop growing. The second thing I'm sure of is more of this population will become richer than in 2014. So infrastructure is all about demographics and ability to pay. Those two are guaranteed in India.
So you're back to the Indian market then because unless you get the primary growth, you're not going to have the secondary market for infrastructure finance. Um, the corporate bond market is non-existent. Where is and we know the problems that the banks have today in terms of their existing exposure to infrastructure. You've created the specialized institutions, but if you're not getting the foreign investors to fund them, then either you're back to your PPP model or the government funding. So either you're looking at the bond market reforms, any views on that? And further, what are the other means then you see of financing for the primary development?
Yeah, what Shailesh has mentioned, fine. See, final projects also require money. So as you mentioned, primary and secondary. So there are some risk takers who takes the invest into this project. So normally in India, yes, some of the institutions are there, and then some of the banks are lending. But these new products, what we're trying to do, no, guarantee come take out. So these type of comforts, if it's given, then money will come into those particular projects, and then definitely the insurance funds and then the pension funds definitely who requires low return and then safe returns. Definitely yes, during the operations, as assets are formed, that can be there. That's one part. Now coming to how to raise this money, so definitely what we have to do is develop the bond market in the country. Presently in India, yes, it is at a very nascent stage. Not much has been done. IFC last year we have prepared a paper and given to the government of India actually, where the regulators are there like Reserve Bank of India, SEBI, and then PFRD and IRIDA, so that some of the policy, I mean constraints which are there for getting more investments in the country, if they are little bit tweaked here and there, then more investments can come. So around 64 recommendations were given to all these institutions. Some of them are being actively looked into it, so that more and more FDI and then FIs can come into it, and then some more investments can come and come into these projects. So that's how the bond market is going to develop. The second one, what we're talking about is to develop this bond market. That's the reason last year the pilot project what we try to do is the credit enhancement. So more and more infrastructure projects which are under operation, when we do the credit enhancement, then those bonds can be listed and then more tradable to then bond market can develop. That's the other one. Then third one is the debt funds, where again bond market can be developed indirectly. So these are the new instruments which have started coming up in the last 1.5 year. So going forward, these will start moving up, and more sustainability of the infrastructure projects will be there. So they will have more butterflies, as Shailesh has mentioned.
So, Mr. Rao, if I can just also ask you to talk a little more about the credit enhancement that IFCL is looking at, and any future proposed models other than the existing models, because I guess that is a key constraint for insurance companies in India and pension funds in India to invest in the sector.
Yeah, actually, this is the first one which we have done is for one of the road project. The basic thing here is what we'll do is after a project which is having triple B, because by the time it has completed the construction, still it be at that level only, triple B minus it may go to triple B plus, and then start earning the revenues. So we step in and then give a partial guarantee up to 30% of the project cost, because again we have to comply with the norms of Reserve Bank and then the prudential norms, so that we can't put everything in the total debt. Part of the debt only we can do in a single project as per the prudential norms. So what we do is we give the credit enhancement to such a level that the rating goes to A or AA. So the bond pricing can be much better than what they are having today. It may have at 12.5% interest rate. That may come down to 10% or 10.5%, so that that particular amount of 30% of the debt can be taken away by someone else in the bond market, because it is already enhanced to the level of around AA, and we are guaranteeing it. If anything happens, I will step and pay you back, because you are the bond holder, you should not be at loss. So that risk I am taking. So these type of we have tried, and almost 5 projects are there in the pipeline. Similar to us, we are requesting PFC also to do. They are also launching this credit, and so another institution is coming in the energy sector. PFC is a big institution, Power Finance Corporation, so that more and more power projects can be done. Same thing, IDFC can also do it, credit enhancement if they want to, because that's also a AAA institution exclusively for the infrastructure. So these 3 institutions and then some more institutions, if they join, I think we can develop more and more credit enhancement in this country, and then we can see that more sustainability will be there in this project.
Thanks. And I think now banks are also allowed to provide guarantees in
They
certain
do it, but they cannot take the risk what the way
too
we can
much.
take as a financial institution for specializing in the infrastructure.
Yes, and they already have an high exposure to the sector. Um, so development of bond markets, everybody recognizes it, but everybody also recognizes 95% of the market is currently government securities.
Absolutely.
So how do we go about? Sure.
I didn't mean to interrupt you, but just on the development of the debt market, um, we have always tended to focus on the institutional investors and then thinking about sort of having an intermediary, let's say an institutional investor or a fund manager, um, and then that fund manager then reaches out to the retail investors in some ways. I think time has come to also start straight going to the retail investors, and this is the reason for that, the iPhone and the mobile phones. I mean, this is a huge market. You know, it's not like the past where you basically were limited to dealing with maybe 100 or maybe 1,000 people, and that's it, because it was all manual. Now you can reach out to a lot of people. Um,
So you're saying
millions
take
of
out
them.
the NBFCs and
No,
and,
no, no,
and,
no,
and
no. I
go
think
direct.
complement. Yeah, you have to complement them. And the cost of retailing has fallen drastically. It is the Amazon model. By the way, why not get Amazon involved anyways, by the way? But the same sort of ideas of involving, the retail investors, reaching out to them more directly, could go a long ways.
But it's a high risk asset class, at least till the development stage. Do you agree? And if you can also talk about, role of securitization in India, because, we've seen globally the hit securitization has taken, but in India, it's traditionally been almost non-existent. So again, as an NBFC, do you see that market developing, and what reforms would you require in that sector, if any?
Well, I agree with Dilip's comment that there is a need to disintermediate and go to the retail investor, but there are significant bottlenecks or issues in that. And first and foremost is that as a retail investor, and I look at a retail, shall I say, a retired person in India who has his life savings to invest in some instruments. So he has a choice. What he can do is he can go to the neighborhood bank and deposit his money in a fixed deposit uh, for, let's say, 7 or 8%. The other choice, as you're saying, is he could choose perhaps, or he could explore to invest in an infrastructure bond, and even if it's a butterfly, as Shailesh said, even if it's a completed asset, but there is some risk, I would say, over and above the bank deposit, and get a return of 10 to 11%. Now, as a retail investor, a retired person will look at the fact that, look, I'm getting an 8%, which is in fact a bond with a daily put call on the bank. It's nothing else, but it's a bond. So he can go to the bank tomorrow if he needs some money for any emergency and withdraw it. So 8% versus 10%, significant risk enhancement. Is it really worth it? That's the mental math that he does in his mind and chooses against it, and again goes to the nearby bank and deposits his money there. So I think till the time the interest rates in the country continue to be as high as they are, and the differential is not perceived to be significant enough, there are going to be challenges in marketing this kind of a product to a retail investor. Uh, and as Pratibha had mentioned that 90% of the market in India from the institutional side is fixed income market, is held by the government securities. So the bond market is limited to securities which are rated double A, if not really triple A. Anything below that does not really find any institutional appetite in the country. And even the double A's and triple A's, they tend to weigh towards the shorter end of the spectrum. And even if you have a triple A bond which is running into 12 to 14 years, it becomes difficult to market to any of the institutional investors, largely because of lack of liquidity in these bonds. So there are large challenges in development of the bond market, and which is not really easy to resolve in a short time frame. There are structural issues which need to be taken care of before this market can be developed.
Sure. And any views on securitizations? how to develop that market? Is it needed in the Indian context? We've tried CDSs, any reforms there to help develop the corporate bond market?
Securitization, when I say, okay, when I look at it from an infrastructure financing perspective, in a limited extent, that's already happening. What is happening is that projects, when they reach completion, the project developer goes back to a new set of bankers and says that, look, I need to top it up with a higher amount of debt because the risks have come down significantly, and therefore I need to top it up with a higher amount of debt. And he often gets it. And not only that, he often gets a reduced rate of interest, marginally so, but he gets it. So to that extent, securitization is already happening. But I think what we need to explore is the possibility that does the same developer need to necessarily continue to hold the project for 15, 20 years? Or can he really, can we really relax the norms to monetize these assets? He should not be required to hold 51 or 26% or whatever that may be for a long period of time. And then it goes on to more stable, more, shall I say, stronger financial hands so that he's able to raise financing at a much cheaper cost and fund it.
And currently it's the norm. They're required to hold it for.
I mean, you've lived abroad. Most people who live in houses which are owned by REITs, the REITs never built those houses, right? The REITs take over the houses once they're up and running. And exactly the same model would be used for infrastructure going forward, as Vineet said.
So do you see infrastructure REITs in India?
Of course.
Do you see the need? And do you see?
Oh, absolutely. This is an idea which is bound to take off in the next couple of years. In fact, infrastructure debt funds might not take off to that extent. And, you know, Srey's IDF is opening next week. But the infrastructure REITs, for lack of a better word, they've been defined as InvITs, Infrastructure Investment Trusts. And SEBI has taken out a discussion paper about 13 days ago. And this is exactly the concept of, you know, the caterpillars getting constructed by the L&Ts of the world, and then the butterflies being taken over by the Canadian pension funds of the world.
If I can also get you to talk about role of external commercial borrowings
Sure.
in infrastructure financing. Again, you know, the success, failures there, and where do you see the future market for that?
So I'll give you two perspectives because we are both financiers of infrastructure in India, and we are also project developers of infrastructure in India. So we have about 14 highways, 8 are tolling. We have 250 megawatt of power distribution within India, and we have a relationship with every single construction company. Now, from a financier's perspective, you know, it's always sensible to borrow cheap and lend at a spread which is high. And coming back to Vineet, your point about development finance institutions in India, I remember the first day of my career with ICICI, I did a ₹1 trillion bond issue. But that was SLR security for banks, so it sold like within 5 minutes. If you borrow cheap, you can lend cheap. So external commercial borrowings today are available at least at a nominally lower interest rate. However, the hedging cost really hikes up the price, as some of us have discovered when the rupee went from 48, 46 to 68. So that's a risk. If you can talk about a stable currency, and if I can get a LIBOR plus 50 basis, 100 basis outside India, it makes a lot of sense to finance Indian infrastructure. However, the real world is not like that. From a project developer's point of view, if I'm a large project developer, let's say like a L&T again, I have fairly sophisticated knowledge about managing risks, and therefore it makes sense for me to go and raise an ECB and finance an Indian project. But typically, the number of such sophisticated developers in India would not be more than 10. And, you know, investment bankers are very good at selling things which later blow up in the face of their clients. So in the 2007, 2008, 2009 era, a lot of iBankers sold FCCBs, foreign currency convertible bonds, to a lot of infrastructure developers, which came back to bite us. So the answer is, it depends.
Yeah, be careful. I will ask the panelists for final comments and also open the floor up for questions. I guess, you know, this is such an important topic. We can go on for another 1 hour, but I'm mindful that people might have questions. Um, it, please go ahead.
To financial market, but I do attend every year or couple of times for last few years international conferences on the investment in India funds organized by Institute of Chartered Institute of Bankers and Financiers. I also attend a couple of meetings in Frankfurt and in Brussels. So the conversation coming into the meetings is practically similar to what you're discussing. But my question today is for our comments today is on 2 points. One is that unlike India, our population is growing old and there are more older people with the pension funds than you can imagine. And a lot of pension funds, like including mine, are significantly larger, which are not getting any interest. But I'm afraid to invest in India because what a lot of reasons Shailesh said and a lot of Mr. Rao also said. Now, if there is a collaboration between the Irish Indian institutions and the European institutions, so if, for example, if my funds are invested in Deutsche Bank and Deutsche Bank have a relationship with any one of you, I'll be extremely happy to invest in India. Yeah, so, but there is none. There are very few collaborations like that where I can find out from Ireland.
No, can I answer? Can I answer that?
Yeah, can I come back to you with one more question?
Yeah.
The reason for that is a lot of time during the economic boom in Europe, a lot of pensioners took early retirement and got a larger handshake in this one year. So the private equity in Europe is significantly larger, which is not growing or which is stagnant and which is in danger of taking over by the government as a soft loan for long-term period. So there is potential for investment is significantly high, but there is no effort from India to catch into that.
Sure, Mr. Rao.
Yeah. Sir, I would like to answer this. Basic thing, if IFCL as a financial intermediary, so that right now we have a relationship with multilateral agencies like World Bank, ADB, KfW, and JICA. And we are right now, as we talk with EIB and AFD, we are talking to them to get the lines. World Bank already $1.2 billion have been used completely in the last 3 years. Then another 400 we are going to get shortly. Now, what I would like to say is, we are a financial intermediary and they are going to invest into the project. So the risk is not that for you to directly put into the project. You give me the line, I'll return back to you because I'm a AAA institution. I take that risk. I know how to manage that. So if anyone wants to do a tie-up with us, we are open for it, IFCL, so that we can have a line of credit and then we can give it back to you as per the agreed terms. So that's how we are managing right now 6 lines of credits.
Thank you.
I'd like to talk to you offline because our group has acquired an Austrian bank, and I've spent a week in Dublin, so I'm very interested in what you're saying.
There's a question at the back. Yeah.
Many of you have been talking about
If you can speak into the mic.
Sure. Many of you have been talking about the Indian investors in India and the global investors in India in the same breath. And clearly, the currency risk is not present for the Indian investor in India. That is present for the global investors in India. And how does one evaluate the currency risk that is involved, like we just saw in case of rupee, and allow that to be played into the decision making or calculations, whatever you call it?
Sure. Mr. Pathak, you want to?
Yeah,
Yes,
sure.
sir.
In fact, this specific question was asked by me of a Canadian pension fund manager. I said, there are 2 kinds of risks. One is the credit risk. The money that you give us is going to come back. And the second is the currency risk, whether you're going to give us at 40 rupees per dollar and you're going to get back. So he actually said that, look, at one time, the Canadian dollar was 62 cents to the US dollar. And over the long term, he said that the Indian economy vis-a-vis the Canadian economy is going to grow. And essentially, currency exchange rates are a reflection of the purchasing power of relative economy sizes. So he said the moment I'm looking at a 2-year horizon, I'm exposed to currency risk with the Indian rupee. When I'm talking about a 25-year horizon, And he said that a quarter for me is 25 years. So over a 25-year horizon, I am willing to bet that the Indian rupee is going to appreciate vis-a-vis the Canadian dollar.
Thanks. Do you want to add to that? Okay. Um,
I had a
Sorry,
question
go ahead.
for Mr. Shankar Rao. I really haven't fully understood what is the structure of IIFCL. Is it a government body, or what exactly you do there? Because I'm from Geneva, Switzerland,
Okay.
and we are working with several Swiss pension funds trying to persuade them to invest into India. And there is interest, but it's very lukewarm interest at this time. And probably what you said just now makes a lot of sense.
Sir, this is a 6 years old Government of India entity, financial institution, specially formed only for infrastructure. So right now the balance sheet is around $6 billion, AAA rated by all the rating agencies in the country, and AAA minus by the Standard & Poor. So that gives the sovereign rating capping. Now we have formed one subsidiary. This is only in rupee terms we give in India for all the infrastructure projects, and special financial instruments we develop for the industry, for the infrastructure growth. Similarly, we have 100% subsidiary which is in UK, London, which gives dollars to the Indian projects in India for the capital equipment in India. So for the infrastructure projects in India only. So for that we have $5 billion line from the Reserve Bank of India from the Forex reserves. We are the only institution. So IFCL is 100% owned by the Government of India, managed by the Ministry of Finance. Now below IFCL, the first one is a UK 100% subsidiary. Second one which we have started is IFCL Projects Limited, which is the advisory company for developing the project development and transaction advisory, and it's an advisory services company. 1.5 year back we launched it. The another subsidiary is this IFCL asset management company, the debt fund, which we want to build a corpus of around $1 billion going forward next 1 to 2 years. So that's also operational right now. So these are the 3 subsidiaries below IFCL, and IFCL is 100% owned by the Government of India. And credit lines are there from World Bank, ADB, KfW, JBIC. And right now we are closing the deals with EIB, AFD of France for 200 to $500 million. And JBIC we are likely to close $500 billion shortly.
And just to expand on that, the infrastructure debt fund, which all the 3 institutions are looking to launch soon, is open to investment by foreign institutional investors, which makes it very easy for pension funds, for sovereign funds to invest, because as an FI you can come in and out because these would be listed, and they are regulated because either it will be the NBFC model or by a mutual fund, as in the case of IIFCL. So for foreign investors looking, and I think the NBFC model looks at only operating assets, and the mutual fund model looks at some developmental assets, but they're credit enhanced. So a lot of the negative sentiment, I think, we as advisors have also seen over the last 3 years. We've been actively involved. We work mostly on the financing side, and for very good reasons, because a lot of the investors, as Mr. Pathak mentioned, had teething problems because they invested in developmental assets. The initial round of investments was pretty much in the development assets because that was the first round of investment, and people saw a lot of pain. So there's a lot of perception out in the market on India infrastructure. But if you follow the developments and the initiatives the government has taken, consistent reforms to allow financing in the infrastructure sector, and we can brief you,
Sure.
you'll be able to convince them much more in terms of what the government is focusing on.
Thank you so much, Pratibha. Follow-up thing. In fact, Shailesh did a beautiful example of the butterfly and the caterpillar thing. It was remarkable. Great concept. It's going to work, and I'm really happy with that. Also, Mr. Dilip Ratha did a beautiful presentation of the diaspora bond. And my next question to him is that, are we really thinking of launching a bond whereby the NRI, the diaspora, can directly invest into these bonds? Because I don't see anything, and this was a question I raised to Mr. Montek Singh Ahluwalia yesterday. The question was that we have almost about $2 trillion worth of assets being held by NRIs outside the country, which is more than double the GDP of the country. Even if they put in 10% of that money, it is humongous. but do we have a product in the pipeline which we can offer to the NRIs living abroad?
Well, just a quick response to that. As far as I know, there is no instrument being planned right now. There are talks about it, but I think, as you point out, it would be a very appropriate instrument to use, and that's where I was putting out the example of the iPhone, because if you are you are reversing the institutional investment mechanism. Instead of selling bonds to 100 or 1,000 institutional investors, high net worth institutional investors, you are flipping it and saying, we will sell $1,000 bonds to 1 million investors. That's the retail. And that's typically we're talking about the NRIs. That has to involve SEC registration. That's the first. And of course, you have to have equivalent registrations in Europe and UK, Luxembourg, wherever it is. And by the way, some incipient research that we are doing now is showing that listing listing outside US, if it is not US SEC registered, then the cost of borrowing goes up by somewhere around 200 basis points. That's a very remarkable new finding, something that has come up only after the crisis. So since 2008, that has to be explored further. In other words, if India were to consider a diaspora bond, it ought to be registered with the SEC. It must be registered with the SEC. And that there is a feeling of fear there. And that is why there is hesitation. But that hesitation comes at a huge cost. So there is that play going on. Many countries outside India are considering diaspora bonds. And there is a task force in the World Bank on diaspora bonds. So Trinidad, Tobago, Jamaica, Nigeria, Lebanon, Pakistan is thinking about one. Bangladesh is thinking about one. There's Philippines. So a number of countries are thinking about it.
May I?
Thanks.
I don't know whether.
Okay, just last question.
Yeah, I
Go
just
ahead.
had an observation about that because, and this is to the point that Vineet mentioned about, as a retired person, I can go to my neighborhood bank and get a 7% return on my money. So why do I need a bond, where I take this risk? So today, what the Indian state offers is various banks offer foreign currency repatriate FCNR deposits. So why do I need a Indian diaspora bond at all, where I'm taking a huge risk because 3.1% is being offered by FCNR deposits, and you mentioned that a diaspora bond would be at about $3 on the dollar. So really, why do I need to take that risk? As an NRI, I can invest in an FCNR deposit.
Sure.
Very quick response. If FCNR accounts deposits are giving you 3.5%, they have to be stopped. Otherwise, it wouldn't make sense. From the borrower's point of view, in which case it is the banking system or the government, whoever is taking that loan, that's a huge cost. You see, if the cost is high for the bankers, then the cost for funding onwards on lending would be also higher. And then a lot of projects will not get implemented because of that. So it has to be properly balanced.
On that note, for that, we need development of our corporate bond markets. We need these specialized institutions, which seems to be the next ray of hope, whether it's the 3 IDFs that we know are going to launch soon, or hopefully InvITs get launched in India. Hopefully all of that will help get the interest rates down in India. Thank you very much to all the panelists for their esteemed views, and hopefully we can take any further discussion forward outside. Thank you very much.
Thank you, Pratibha, for moderating the session, and thank you all. We will straight move to the next session, which is a little late, but that's okay. Okay. Thank you. Thank you all. Thank you.